For more on what this could all mean for the markets, let's bring in Andy Constan. He's the CEO of Damp Spring Advisors. Andy, great to see you.
Great to see you too, Melissa.
You know, the reaction to New York Community Bancorp seems to be fairly contained. There was not too much reaction when it came to any sort of move in yields, like a flight to safety. There's not that sort of, fear of a flight of deposits out of banks. Are we past the worst of it?
Yeah, so, I mean, to borrow a phrase from a friend on Twitter, policymakers have been acting to stabilize the market, banking system, and economy as if each were a child's Tamagotchi. Treasury announced large bond offerings in the summer, only to reverse on Halloween when bond markets sold off 100 basis points. The Fed focused us on real Fed funds in December, and markets extrapolated to a complete pivot and a beginning of a cutting cycle, which the Fed is now aggressively walking back as financial conditions ease. Just 11 months ago, equity markets fell dramatically as Silicon Valley Bank and others collapsed. But with New York's Community Bank in stress, markets are confident that the policymakers will have their back. If you look at issuance shifts, rate forward, path forward guidance, Forex repo, reverse repo, and QT taper talk, you can see heavy intervention to keep things on the path to a soft landing. We may get there, but clearly with a 4.1% 10-year, a buoyant equity market, and an economy with GDP running above 3% for going on 3 quarters in a row, the policy stance is not restrictive. That bodes well for stocks over bonds, but stock markets are being led by a scant few names.
Yeah. Tamagotchi, those are those little tiny, digital toys, pets. And you feed them and all that. Okay.
And if you don't, they die.
Oh, yeah.
Children need to be cared. You need to care for them. So
right.
There's this care going on.
Yeah, I was just thinking of the legions of viewers out there who have no idea what you're talking about. Just wanted to clarify. In terms of your positioning, you said stocks over bonds. Is that reflected in your own portfolio?
Yeah, I think there's a chance that this exuberant. Well, let's step back for a second. On Friday, there's a very big number coming out, and it's not something that people follow. It's a fairly esoteric thing. But the Fed has mentioned it extensively, and that is the revisions to the CPI. And if those revisions, which are on the seasonal factors, show that the progress that has been made in the last 3 to 6 months on inflation was revised to not being progress, I think markets broadly can struggle a lot. On the other hand, if the inflation target continues to show this progress, equities should do fairly well. Bonds still seem extremely rich, given the very large supply that was announced last week and the broad likelihood that taper is going to be delayed. So, yeah, I prefer equities over bonds. I'm short bonds.
Andy, it's Karen. Thanks for being on. So the auction that we had today, which went well, the biggest auction ever, right? Does that give you any comfort that the amount of bonds that the Treasury needs to sell can be absorbed, or is this only one data point and you don't read much into it?
It's one data point. I think you have to look at the term premium that currently is priced into bonds that make them, frankly, unattractive relative to cash, the very steep inverted yield curve that makes levering for carry trades unattractive. And it's one of these things where if there's enough supply, which has to be absorbed, and that's $500 billion of net coupon new issuance every quarter for as long as the eye can see, based on their most recent quarterly refunding announcement. The pressure for bonds to, increase in yield from 25 to 50 basis points on the long end is there. Any one day, it could be random. And the NYCB bank situation is creating some demand for bonds in the very short term.